Hi, I'm Jimmy. In this video, we're looking at the US economy to see if we think that the US economy is going to get stronger or weaker. We're going to use different economic indicators to ultimately try to answer the question, do we invest now or wait for the stock market to crash again? Our first economic indicator is an important one, and this is the yield curve. So this is the US Treasury yield curve, which tracks the interest rate for US Treasuries for different time periods. And sadly, this yield curve is actually known as an inverted yield curve because short-term rates are higher than long-term rates. This is a bad sign for the overall economy because an inverted yield curve has preceded every financial crash in stock market history for like the past 100 and some odd years. So this is a bad sign. Now, if we're curious, the yield curve is supposed to be normal yield curve is shaped like that. It's supposed to be heading higher, which makes a lot of sense if you think about it. Short-term interest rates, for example, if you're going to invest for 3 months, you should receive a lower interest rate than if you were going to invest for 30 years. That is why it's normal. The current yield curve, you receive more money for investing shorter than you do longer. Overall, that's a problem, and this is going to be a bearish point for the US economy. So on our scorecard here, our first point goes to the bears. Okay, up next, we've got consumer confidence. So ultimately, what consumer confidence is it tries to measure how confident individuals or families are in their financial position. So that's everything from expenses, how much life is costing them, to how much money they're making for wages or how secure they feel their jobs are. This is a very important number because the consumer is one of the most important parts, one of the biggest drivers to the US economy. So obviously, higher is better here. Higher consumer confidence is a good thing. We could see last year, the numbers sort of bottomed out here back in mid-2022, and that's clearly a bad sign. Now, since then, the number has gradually recovered, which is a positive sign for consumer confidence is beginning to get up to hopefully more reasonable levels. Now, I was on the fence with how to score this one. Do we make it a bearish point or do we make it a neutral point? We can see on the scorecard here that ultimately I decided to go neutral on this one, and that's only because the recovery has happened over the past few months. It wasn't just a one-up and back down, which sometimes happens with consumer confidence. But if you disagree with this and you think that consumer confidence should still be in the bearish category, please let me know in the comments below. Okay, next up, we've got the job situation. So we're going to look at the U3 unemployment rate. Now, we can see that, according to this chart, the U3 unemployment rate is currently at its lowest level in about the past 20 years, which is clearly a good sign for the overall economy. But I understand the criticism of the U3 unemployment rate. The criticism is that the U3 unemployment rate ignores people that are underemployed. Maybe they're at a job, but they're not making as much money as they should be making, or maybe they can only find part-time work, something like that. To better match those numbers, we should really look at the U6 unemployment rate. But I would argue that the difference between the U6 and U3 unemployment rate, yes, the U6 unemployment rate is higher, but the result is really the same. The U6 unemployment rate is also near its low over the past 20 years. We can see that the two numbers move nearly stride for stride with each other, just the U6 unemployment rate is higher. In either situation, it looks like jobs is going to be a point for the bulls. So, jumping over to our economic scorecard here, we can see that this is a positive point, clearly, whether or not we use the U6 or U3 unemployment rate. Okay, now we're going to look at the real problem for the US economy, and that's inflation. So this is the Consumer Price Index. The Consumer Price Index is the most popular way to measure the changes in the cost of goods and services, at least the measure that the Federal Reserve uses the most. And clearly we can see here that the numbers are moving much higher. At least they were moving much higher until the latter half of 2022. Clearly this is a problem. In fact, if we were to look at this chart, let's say over the past 40 plus years, well, over the past 40 plus years, the current numbers still look terrible, even though inflation has pulled back just a bit. But even coming off of the bottom of this rectangle here, the bottom is about where the current numbers are. Still higher than it was going back to the early 1980s. So it's been a long time since inflation was this high, And clearly, this is going to be a point for the bears. This is a real problem because this problem is something the Federal Reserve has to react to. They have to react. And because of that, that could cause a lot of headwinds going forward. We're going to come back to this towards the end of the video when we're trying to determine if we invest now or wait. Okay, now we're going to go to the other side of inflation, and that's looking at the growth in wages. So this is the wage growth tracker that the Atlanta Federal Reserve puts out. And we can see that wages have been higher recently. So overall wages, year-to-year increases in wages has been up. But over the past few months, wages have, although they've been at a higher level, they haven't been quite as high as inflation has been until just recently. So we can see that we saw that with inflation pulled back a bit and wages only pulled back moderately. They're both right near each other from a which one is higher perspective. So this is actually a good sign. Early on when inflation was going up, wage increases was sort of forced upon us. That's why we had this spike somewhat in line with this spike in inflation. But if wages can linger and the two can balance each other out, that could be a little bit better. Now, this could be a problem for the Federal Reserve because if wages stay high, oftentimes inflation will stay high because people have more money to spend. More money to spend will cause more inflation. So the Fed might have to continue to increase interest rates, which could be a problem for the overall economy. But either way, looking just at wages, when we jump over to our economic scorecard, this is clearly going to be a point for the bulls. The fact that wages are near where inflation is right now, I'm not worried about that. So we're going to keep that as a point for the bears. Wages is a point for the bulls. Okay, now we've got household debt. So this is a measure of household debt compared to GDP. So 100 means that household debt is the same as GDP. What percentage of GDP is household debt? And we got to look at this and say, okay, is this for the bulls or is this for the bears? Is this a good sign or a bad sign? Well, clearly it's a bad sign if we're looking back at the past 50 years, since it's much higher than it was all that time ago. But over the past 20 years, household debt is actually looking decent right now. Now, for me, as I'm trying to determine the score that I think is most appropriate for this, I actually think when we look at this chart, it's not fair to compare how much debt we as an economy had back in the early 80s compared to today, because interest rates back in the early 80s were significantly different than they are today. Back in the early 80s, if you're going to get a mortgage, your mortgage rate would be double digits, 10, 11, 12, 13, 14%, and those were decent rates. Today, you're significantly lower than that, so with lower interest rates would be a naturally higher amount of debt. So with that in mind, when we jump over to our economic scorecard, well, I actually think it makes sense to give this point to the bulls because debt is down over the past 20 years, and it's likely to continue to go down if the Federal Reserve keeps pushing interest rates higher. Okay, now we're going to shift over to a different part of the analysis, and we're going to look at manufacturing. So this is the ISM Manufacturing Economic Indicator, and the key level here is 50. Anything above 50 implies positive growth in the manufacturing sector. Anything below 50 implies negative growth in the manufacturing sector. So clearly, right now, this is an easy point for the bears because it's below 50. So this one's an easy one. Manufacturing has struggled over the past few months. No signs of turning. Easy point for the bears. Okay, now we're going to shift over to housing. So we've actually got two economic indicators. The first one is the price of existing home sales. And we can see that recently the price of existing home sales did pull back a bit, which you would think is a bad sign. But it's pulling back right after there was a big jump coming out of everything that happened with COVID. So when COVID happened, they dropped interest rates. The government started pumping money into the system, started giving money to people. So a lot of people jumped out, started buying houses. So the price of houses really went through the roof, at least in certain regions. So I think that it's difficult to determine whether or not this is a bullish point or a bearish point just with this chart. So I think it makes more sense to shift over to a different economic indicator that also looks at housing, and this is housing starts. So this is the number of new houses being built. How many new contracts are being taken out to start building houses, mostly by home builders. And we can see that recently, this number has dropped a decent amount. And this is a bad sign for the overall economy. So when we jump over to our economic scorecard, I think it's fairly obvious that this has to be a point for the bears, because a weak housing market, when we look at the bigger picture economy, is a problem. So that's an obvious point for the bears. So when we look at our overall score here, we can see the bears are leading 4-3. Now, this chart implies that every point is sort of the same. I actually don't think that's fair. I actually think that inflation and consumer confidence are two of the most important economic indicators to watch. And inflation is clearly a point for the bears. And right now we have consumer confidence as a neutral point. So if anything, I'm even leaning more than 4-3 in favor of the bears from a bad sign for the economy at this point in time. Now, people have complained in the past. I've seen different comments where people say, well, why is it split 50-50? And generally, that's the way the economy goes. Very rarely are all of these bullish points or all of these bearish points. Usually, there's parts of the economy that are doing well, other parts that are struggling. That's sort of what this represents. The idea here is to look and try to understand, does investing now make sense? And as always, I think that investing almost always makes sense opportunistically. I think that we've got to find where the opportunities are. Right now, manufacturing is struggling. That could be interesting. Housing starts is struggling. Home builders are probably struggling. I haven't looked at the charts of stocks, of the home building stocks, but I'll bet you that they're not doing all that great because housing starts are declining. Those could be, for long-term investors, good opportunities. So as far as do we invest now or wait, I think it makes sense to invest now. Hopefully what this does for us is gives us an idea of where we should look for the best value opportunities, then buy and hold for a very long time, of course, after we do our own research. Now, if you'd like to know how to analyze stocks, I actually did a video in the past where we break down the 8 steps to analyze the stock. So if you're curious, I will leave a link to that video right here, link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.